Investing in properties used to be a popular tool for wealth accumulation and legacy planning. But with successive rounds of property cooling measures of late, it has become less accessible to the everyday man. Through REITs, retail investors can gain exposure to property or diversify to other property segments without the hassle and cost of owning a full physical property. They are also a lot more liquid than physical property. So, what exactly are REITs? Welcome to Understanding REITs by The Edge, Singapore. REITs account for about 13% of the Singapore Exchange's market cap, or around $110 billion. That is a staggering chunk of the market, considering there are only 29 sectors in total. In this four-part series, we'll first find out what is a REIT, what it does. We'll also find out the considerations REITs face across different sectors, changing market trends, and economic cycles. In the first episode, we will explain the basic terminologies and measurement metrics that are more commonly used when assessing REITs. We will also look at distinct characteristics of REITs as opposed to other asset classes. In episode 2, we explore different property types managed by different REITs, and each has its own characteristics, opportunities, and challenges. For example, a REIT managing retail malls has vastly different considerations and value drivers from a REIT managing hospitals or hotels. In episode 3, we embark on a case study with an industrial REIT in Singapore. We investigate the business consideration and drivers that underpin a successful REIT, all the way from the quality of its assets owned to its tenant mix to the significance of global, economic and industry trends, both long and short term. We also speak with Mr. Adrian Chui, Chief Executive Officer and Executive Director of ESR Logos Funds Management Singapore Limited, the management of ESR Logos REIT, for his perspective on how ESR Logos REIT has grown its portfolio by over fourfold, from $1.35 billion in 2017 to $5.5 billion today, and transformed its portfolio as we enter into a post-COVID era where secular, geopolitical and economic trends, together with dominant technology-centric sectors such as e-commerce, logistics, data center, infocom and advanced manufacturing, have changed the way goods are produced, delivered and consumed. In episode 4, we sit down with Ms. Karen Lee, Deputy CEO of ESR Logos REIT's manager, to understand the day-to-day running of a REIT. We've also given a special tour of their facilities for an on-ground experience. This will help us translate numbers and figures into real scenarios. At the end of this four-part series, we hope to provide you with better insights into the REIT business. We should end off this series having learnt about how REITs endeavour to deliver consistent cash flows, the metrics in assessing REITs, major factors affecting profitability, and managing risks. To better illustrate what an industrial REIT is, let's start from the very beginning using the S-REIT model. State land is first launched through government agencies like JTC, URA and HDB. Alternatively, land can also be purchased from private landowners. In our example, the government launches an industrial land parcel for public tender. A developer wins the bid for the site to build an industrial building. Construction of the building begins, and within years the building is up and running. The developer then hires a property manager to maintain the building, determine the rental prices and, of course, rent out space to tenants. At this point, significant value has been added to the vacant land. Developers can develop many buildings in this manner. Once the properties reach a high occupancy level and rent stabilizes, the developer packages the properties together to form a REIT with the intention of listing the REIT. This frees up capital for the developer to recycle into new developments. The developer becomes the sponsor of the REIT to house the industrial buildings when it undertakes an initial public offer or IPO by offering units in the REIT to investors like you and me for subscription. In Singapore's externally managed REIT system, a REIT manager and property manager are required to manage the REIT. The REIT manager is responsible for the strategic directions, growth and performance of the REIT, while the property manager manages the daily operations of the properties in the REIT. In turn, the REIT pays the managers a fee for running it. The REIT manager and property manager are owned by the sponsor, while investors own the REIT. In most REIT IPOs, the sponsor will own a stake in the REIT, which ranges from 20% to 40%. The remaining 60 to 80% is in public hands. Once the IPO is successful, investors like you and I now own a slice of the properties that are in the REIT. Every month, tenants pay rent to the REIT, and the REIT uses the money for property maintenance and utilities costs, property taxes and land rents, financing costs, payment of management fees to the REIT manager and other service providers, and other admin costs like trustee fees and audit fees. Thereafter, remainder monies called distributions are paid out to unit holders of the REIT. Under Singapore's REIT system, it is mandatory for REITs to distribute at least 90% of their specified taxable income in order to be eligible to not pay corporate tax. We call this tax transparency. This makes REITs attractive to investors seeking dividends. REITs usually pay distributions quarterly or half-yearly. This dividend is termed distribution per unit or DPU, which we shall define later. Now let's talk about the scope of the REIT manager and sponsor. The REIT manager's scope includes developing and executing strategies for the REIT in accordance to its investment mandate, preparing the REIT budget, identifying and undertaking asset enhancement initiatives and/or redevelopment opportunities for the properties in order to enhance their value, monitoring existing and seeking new tenants and ensuring rentals are paid on time, acquisition and disposal of assets, ensuring compliance with statutory rules and regulations and good corporate governance practices, and managing the financing and overall capital structure of the REIT and timely reporting of the financial performance of the REITs. The most successful REITs are those with strong sponsors who provide both asset pipelines for the REIT to acquire and financial support. REITs are required to pay out at least 90% of distributable income. As a result, REITs fundamentally do not retain cash and have to fund their operations and/or acquisitions with a combination of debt and equity. Strong sponsors show support, alignment and validation of the REIT's investments by providing a backstop for the REIT's equity fundraisings. At this point, we should highlight the various financial metrics that investors peruse when investing in REITs. We've broken them down into three broad categories: investment returns, capital management, and operational metrics. Net property income, or NPI, is obtained by subtracting property expenses from revenue. Distributable income is income available for unit holders after subtracting all the REIT's operating expenses, interest expense and fees from NPI, and adjusting for non-deductible items such as depreciation and amortization, any gains or losses on the disposal of any asset, future income tax expenses and future income tax benefit, and any other adjustments as determined. DPU, or distribution per unit, is the distributable income divided by the number of units. Net asset value, or NAV, is the total value of the REIT's assets minus the total value of its liabilities. Interest coverage ratio is defined as the NPI less fees divided by interest expense. Aggregate leverage, or gearing, is the ratio of the REIT's total debt to total asset value, or more commonly known as loan-to-value ratio, or LTV. The regulatory limits for gearing is 50%, subject to a minimum ICR of 2.5. For REITs with ICRs lower than 2.5, the regulatory gearing limit is 45%. Investors monitor the weighted average tenor of debt in years. The longer, the better. There is also hedging, where there are two aspects: interest rate hedging, which is fixed rate debt as a percentage of total debt and the length of the hedge, as well as foreign exchange hedging for REITs with overseas assets. That is, how much of the borrowings are in local currency and how much of the income coming back to Singapore are hedged to prevent losses due to FX movements. Weighted average lease to expiry, or WALE, is a metric used to measure the stability and growth potential of the REIT's earnings capability. Occupancy rate is the percentage of the portfolio that is occupied by tenants. Rental income depends on whether the properties are rented out. High occupancy spells good news for unit holders. Rental reversions measure the likelihood of an increase in rental income going forward. A positive rental reversion would mean that rental rates increased upon renewal from expiry. Top 10 tenants' percentage contribution to the REIT's total rental income measures the diversification or concentration risks of a REIT's income stream and profile. A high percentage means the REIT's income is highly dependent on a few tenants' ability and continuity to pay rents. Evidently, many of these metrics are what you, as a landlord, will be concerned with if you were to own all the properties under management yourself. It is important for investors to think holistically as unit holders of REITs. Some metrics may be counter-cyclical to other metrics, and hence it's the REIT manager's responsibility to achieve a balanced risk-return metric for its unit holders. We've talked about the basics of REITs, and in our next episode, we will be discussing the different types of REITs. There are 7 in the Singapore REITs market, and we shall explore each and every one of them the next time we meet.